Good evening, everyone. Welcome to today's session. I am your host, Prachi Pandey, for today's session, and the expert is Hariharan Kumar. We will be starting the session in a minute. Before we start, I would like to add that the expert will be looking at the questions in the chat box. So please do refer to your questions in the chat box. We will not be allowing you unmuting. We will not be unmuting you for the duration of the session. So your questions will be answered in the Q&A section, and it will also be answered towards the end of the session. All right. So it is our great pleasure to welcome Hariharan Kumar for today's session today. Hariharan Kumar is a principal associate at Cyril Amarchand and Mangaldas, based in Mumbai, Maharashtra, with a distinguished career in the legal profession. In 2022, he achieved a remarkable double promotion, of advancing him from a senior associate to a principal associate. He is recognized as a key lawyer by the Legal 500 for his works in the firm's Tier 1 ranked projects and energy practice. Sir has also established himself as a trusted expert in the field, further demonstrating his dedication to professional excellence. He also qualified for SQE1 on the first attempt, and he's here to help guide us on today's topic. Let's give him a very warm welcome, and I'll be turning the session over to you, sir.
Thank you so much for the kind introduction, Prachi. I hope everyone's able to hear and see me. So we can get started. So first of all, thank you for taking out time while there's an India-Pakistan match going on. So thank you for that. So I think this presentation is basically, I'm not fully going into the legalistic aspects of this. This is my topic. It is private credit in India in general, and generally what kind of opportunities you will have in this sector, whether you're a lawyer, whether you're a CA, whether you're working in any other profession or field, which is relevant to financing in general, and how the practice or how private credit has grown in the last few years, what is broad outlook for the year, for the next few years, and the challenges that are there, right? So with any growing sector, there will be challenges given the nature of the industry that we are in and the regulations that we're all going by. So that is the broad agenda. In terms of the subsets, I just briefly described those, but we will be analyzing how the sector has grown, what was some of the triggers that caused the growth of the sector, what are the various opportunities available, then going into a bit of legalistic in terms of what are the kind of modes that private credit can be in the form of, right? And what are the regulations surrounding that. The last is challenges facing the sector and as well as the role that it has played generally and will continue to play in the foreseeable future for corporate India in itself. Yeah. So for people who don't know what private credit is, I mean, it is a different term from what you know as a typical financing, right? Typically entities will borrow debt from banks, right? Whether it is a traditional project financing, working capital, or generally corporate loans, right? That is the broad idea of loans in India. You will turn back to banks, right? What is private credit? So just going into what it generally entails. It is basically in a simple form, it is non-bank lending, right? What is non-bank lending? There are different players in the market, that there are different borrowers in the market, and how to cater to those unaddressed so-called markets to say. So simple example, let's say somebody which is a big power corporate house like Reliance, let's say it'll be easy for them to access funds from banks. They have great credit ratings, they have great revenues, etc., etc. But what about other markets or other players in the industry that do not have the requisite, they're in a growth stage or they need funds for certain specific requirements or certain specific needs? How do these guys get funded? Where a bank is unable to fund, that is where private credit comes in. It can be complementary with each other, not to say that banks cannot necessarily do what a private fund can do, but it is in the way, it is something that may offer maybe better options for the borrower to itself take the debt. So it is basically, you can lend to SMEs, mid-sized firms, distressed companies, startups, etc. These kind of are the typical borrowers. And the reason while we'll discuss the reasons and the advantages that private credit offers, typically these lenders are a bit more flexible in terms of what they can offer up, whether as part of the terms of the debt or terms of the loan, and generally in terms of how their entire debt is structured, right? Banks, you will know, a typical bank mechanism. There is a fixed tenor for a loan, whatever that may be, depending on the purpose. There is a fixed model where you need to pay it interest at the end of, let's say, a month or a quarter or a year. That is the limited flexibility, right? Everything goes through a centralized process of that relevant lender, comes with a certain identified format, and that is what is implemented with the borrower. There are requirements for the company to, let's say, have a particular rating. There may be requirements for the value of security in case of a secured loan to be certain value, right? So though there are some of those hardbound conditions that a bank will look at while it sanctions your loan. Let's say you as an individual are also going to take up a loan. They will look at your CIBIL rating, they will look at your credit, they will look at how your usage of credit has been and all of those things before they sanction your loan, which is broadly similar to what others of your similar category or similar credit rating may offer. Private credit can vary from depending on the nature of the risk, depending on the nature of the reason why the loan has been taken or why the debt has been taken. So that is the general broad idea of what private credit is in the first place. Key players, which some of them we will delve into, are NBFCs, which are non-bank financial companies regulated by RBI. There are foreign portfolio investors, which are regulated by RBI as well as SEBI. There is AIFs, which is alternative investment funds, which are very active in the market or are growing up at a big scale. Both FPIs as well as AIFs, we will be discussing that in larger detail. Additionally, there are huge private credit, private equity firms that are available, who mostly you would have seen in the news, like startups are being funded by private equity as well, right? So that is one of the players that is available. There are hedge funds which are not so active in the market right now, in Indian context at least. There are family offices which are basically ultra high net worth individuals who have invested in those projects, etc., etc., in the company itself. So that is one of the means for ultra high net worth individuals to basically put their money in an instrument or an investment which will probably give them a higher return than, let's say, what a fixed deposit will give you or other alternative investments may give you, right? So it's a way for them to also diversify their portfolio. And family offices have become more and more prominent after Gift City, which is in Gujarat, has been set up. Reason being tax structuring and all of that associated with that. It's another alternative for them to earn money out of the funds, right? Now let's talk about the size. Globally, it's a huge market, specifically in Northern America and all of that. It is a 2 trillion market globally. India is obviously picked up in the last few years for some of the factors and reasons that we will discuss soon. And it is estimated as per EY to reach a value of 100 billion USD, 100 billion by 2025, which is the year that we are in. So that is a fairly good share. Let's say, I think it's about 5% of the global market, which, so obviously, given the size of India, the size of the economy, the growth of the economy, there is a lot of potential for this to grow significantly further. So that is about the size of it and what opportunities will come up or have come up in the last few years. Now, what are the forms? We will discuss some of the specific structures around in the later slides, but private credit is not restricted to one form, right? It's not a simple loan that a bank may give you. It can be in the form of loans by, let's say, an NBFC, for example, which has been prevalent in the market for some time. It can be by way of subscription to non-convertible debentures. There are quite a few layers to that. It can be listed debentures, unlisted debentures. Similarly, something a bit more hybrid than a pure debt product like NCDs is optionally convertible debentures. So we will try to look at some of the structures that have been followed in the past. So I will move on to the next slide. Yeah, so this is again stemming from a previous slide where we spoke about the size. We can just take a quick look. This is basis RBI's financial stability report in June 24, where they analyzed some of the how private credit is coming up and has acknowledged the growth of it. And therefore that stems the need for larger regulation or greater regulation, so that doesn't impact financial markets as a whole. So we will discuss the RBI report in the challenges section, as well as what thoughts they had to offer, because it is the primary regulator for funds coming into India or borrowings by companies or lending by entities, right? So that is something we will discuss. So broadly, the number is around 2 trillion, like I told you. This is up till 23. So that time the number is around 1700, 1800 billion, which is 1.7, 1.8 trillion. And India's share in that is around 400. Asia's share in that is around 400 billion, which is like less than 20% of around 20% of the market in this very large Asia Pacific, which has like global hubs like, let's say, Hong Kong or a Singapore, India's share in that is obviously limited. It's not the entire Asia Pacific share. So let's say Asia is around 20%. You can see Northern America being like 900 billion, which is like almost half the market over there. So that is where we can tap, where India can reach new heights in that if the strategies are implemented well and legal reform support all of that. Yeah. So I made a summary of some of these points in my introductory slide, but going on in terms of what has couple of slides on how the growth has been of private credit in general. Like I said, the first driver has been the need for alternative sources of financing. There has been a gap in financing. There is not necessarily everybody who can access banks or banking system in general. Because like I said, banks have a certain specific requirement or may not, because of regulatory restrictions, able to finance the kind of thing that a company was looking into, which comes to my second point in this slide. Regulatory constraints. Taking a very simple example over here, banks, for example, are not permitted to permitted to give acquisition finance, right? What is acquisition finance? It is basically a company A borrowing funds from a bank or from an institution to purchase company B, right? That simple thing banks are not allowed to do, right? So if company A wants to purchase company B, it can, let's say, use its own funds, use equity, use XYZ sources, but banks cannot fund that. But given the nature of the market, the competition and everything, there are acquisitions going on day to day. And everybody may not want to put in their own funds, even if they may have. So therefore, these are some of these things which banks cannot finance. So there is a need for private credit to come into these fields, right? The private credit may not be subject to these restrictions. There are obviously individual type restrictions, which we will not go too much into detail, but as a broad theme, there are things that if private credit can do, which banks can't do. There may be things that banks can do, which private credit can do. For example, the size of the investment that a bank may make, right? Banks are obviously much larger. Simple example, an SBI can finance a project of a scale of finance, give that much amount of financing, which a private credit deal may not be able to get that company, right? They have the resources, they have the funds, and they have the appetite to fund maybe long-term financing. Whereas private credit is not typically a long-term finance. You will not see a private credit in a, let's say, a project finance transaction, right? A project financing in a conventional sense is a long-term loan, right? Which the bank or entity will give, which loan is repaid through the life cycle of a project. When I say life cycle, it is the entire tenure. For example, if it's an energy project, it will be renewable energy, the length of the PPA. Or for example, a road project, the length of the concession, right? That is the period during which the loan will be paid. It is not something like a 2-year loan, 3-year loan or something. It will be a 20-year or a 30-year loan. Private credit may not have that appetite to sit around for such a long time. This is fairly, in a way, to compare it with the project financing, it's fairly short term. Let's say a 2 to 5 or 2 to 6 year tenor. That is what traditionally I've seen. 2 to 4 is what I've seen, but 2 to 6 is what we can take as the range of what these type of financings may be for. The third point in this slide is basically investor appetite. We have seen institutional investors, large institutions, let's take an entity like a Blackstone or a BlackRock, which are huge global players, or a Goldman Sachs, huge global players who are looking to tap into the Indian market as well, maybe more than what they already have done in the last few years. So there is enough interest in the market for such kind of debt to be made available. So that is the third point. And the next points which I mentioned in my slide are something that I briefly discussed. A traditional bank financing has some rigidity associated with it. It may follow a certain template or how the banks have traditionally given in the past, whereas private credit is a bit more tailor-made depending on what the borrower needs the funds for, what is the end use of those funds, etc. How long will it take for those funds to be repaid? Analysis of the business revenues as to how this source of repayment can come, right? So therefore, there is more flexibility in those aspects. Interest rates can be structured differently, will look significantly different from what a bank can give you a loan at, right? Banks traditionally may go through an MCLR plus plus approach. When I say MCLR, the marginal cost of lending return that RBI publishes, and that they charge a spread over it, spread being their share of the profit or whatever you want to call it. Spread is basically something over and above the MCLR, which is their way of making the money. It's traditionally linked to that model in India. In this, it can be linked to a simple interest can be something called an IRR, which we will discuss, which is a rate of return. It can be something that is not just payable at a certain identified timeline. It can be, let's say, payable only at the end of the loan, which a bank may not offer you a long moratorium of this sort to kind of pay, let's say, the interest for a 3-year debt, no interest payments for a 3-year debt, which a private credit may have the flexibility to do. And we will talk about some of those deals as well, where this has actually been done. So that is how it helps companies. They can structure their cash flows, they can structure their entire business basis, the type of debt they get, the type of schedule, repayment schedules, and interest rate mechanisms that they get. Yeah, and then again, the next point we discussed this. It services diversified interest. It gives companies access to pools of capital that they did not have before. Like, so it can be in different forms, not just conventional debt models like a conventional loan. It can be a hybrid. It can be a mix and match of debt plus equity. It can be pure debt structured in a different form. And traditionally, the speed of execution has been faster because you have a much more professionally managed setup, and you also have uh, you also don't have to go through the entire process that, let's say, a bank may have to go to. When I don't know if you're aware of a loan sanction process. It takes a lot of time, right? Because banks will do a full detailed credit assessment. They'll go to multiple committees, which may slow the speed of execution, right? Which a private credit may be a much more faster opportunity for them if companies want to access funds earlier than what they want, earlier than required. Yeah. So the next one is on the key drivers of growth. So I would say that private credit started its journey in India potentially maybe after 2008, which is when the global financial crisis happened. That is when there was a need because there was a huge collapse in the entire global system. NBFCs at least started cropping up during the 2008, post 2008 period a bit more, right? And professionally managed NBFCs, let's say Edelweiss and all of those guys who are, or let's say your local players as well, started to crop up. Then there was a moment in India's system, let's say during 2013 to 19, where there was huge NPAs that are plaguing the system. Don't hold me to the numbers, but I think the percentage of NPAs prior was around 16%, but now has been brought down to 3%. So there was a huge amount of NPAs, which is non-performing assets, which were there in the system, which kind of restricted banks' ability to provide funds to borrowers because they were themselves suffering to recover some of the loans that had gone defunct, right? Let's take your Kingfisher, for example, or many other loans which caused a massive stress in the system. The second thing that happened, which was in 2018, I don't know if you all are aware of what happened to ILNFS. So ILNFS is basically infrastructure leasing and financial services. That was a huge company. It was a AAA rated company. So that is the highest standard that you can have for any company in India in terms of ratings. It had debt of around 1 lakh crores across its subsidiaries. That was a huge chunk for India's financial system. ILNFS collapsed in around 2018. Okay, so that caused, and a lot of banks and NBFCs had invested a lot of money in that. There were and most of these loans could not be repaid, or why the default happened is because of cash flow mismatches. When I say cash flow mismatches, it means the ability of the business to generate the revenue was not commensurate with the amount of obligations you had to pay the lenders, right? So that caused or provided more of a need to have alternative structures or flexible structures that works in line with the business revenues, whichever business you may be in. There may be business uncertainties, there may be force majeure events, there may be once in a lifetime events like COVID. There may be general, toll suspension, for example. During demonetization, we had seen that. There may be general outages in the power system, which can cause a project to not generate revenue. So these are some of those things which focused on private credit a bit more. There have been also numerous regulatory reforms which have come past in the last 10 years, if I can say. The biggest being for a creditor was the IBC. IBC is the Insolvency and Bankruptcy Code, for people who are not aware. This code came about in 2016, which provided basically a manner for creditors for a company to continue to be in a going concern way. Even though the company may have suffered financially because of which they defaulted on the loans, it was a way to kind of restructure the company and make them good companies or functional companies, performing companies, so that the lenders could get their dues, where a new management takes over, a new entity bids for that company and takes over the business. and is able to run it in a more efficient fashion, which ensures recovery of that debt that is already taken by the company. So that provided a focused, streamlined process within which how creditors could enforce their rights or get back their money potentially, with the overall objective of keeping the company going concern. So it is not primarily a recovery measure. It's not a recovery tool, which the Supreme Court has clarified multiple times. It is a means for keeping the company alive, keeping every stakeholder's interest alive, keeping all of those. Then we would have there are also other sectoral developments in different sectors like RERA, which came about in 2016 again. Before RERA, there was no one site authority which would oversee all real estate projects, or how it was operated, how there was whether there was diversion of funds, whether there are delays in construction, etc., etc. That is another tool which has ensured a bit more streamlined process in how real estate generally is managed, whether in terms of how they can borrow, how what are the timelines, and what are penalties associated with failure to deliver within the timelines, right? The third thing which was introduced, I think, in the budget 3 or 4 years ago, I'm not too sure, and this is the Bad Bank, which is the National Bad Bank, which has been launched by the government of India, which is basically trying to clean up the system by acquiring or funding, purchasing distressed loans, which is yet another means to reduce the NPAs that banks are suffering, so that banks are able to have enough capital to sustain further businesses, sustain further developments, and they are not saddled with the risk of recovering the loans that are defaulted or which have become an NPA. So these are some of the three, four. There has been GST as well. There are other impact or other developments in this field, but these are some of the 2, 3 things that I could specifically think of. And economic growth. So India has obviously been on a close to 8% growth on an annual basis, right? There is definitely a need for capital for whatever reasons, whether it is for the business, for reducing competition, for improving competition, for all of these aspects. So there is rising demand from SMEs and mid-sized and startups to kind of grow their business to reach a stage of competing with, let's say, global players or national leaders, right? So there is demand for that. And next point on providing growth capital is something which I just discussed. Different needs. You may want to expand your operations. You may want to set up a new plant. You may want to launch a new product. You may want to launch a new line of business. You may want to do acquisition financing. All of these things become relevant for private credit, especially where banks may not be able to participate, or banks may not be that competitive in that sense. So that is the next one. Then there, like I said, private credit will not be a fixed rigid model. It is tailor-made, customized, etc., to what the borrower's requirements are, and so long as it helps meet the investor's objectives for earning out of it, right? So you can companies may use this to optimize their capital structure. They may take a mix of debt and equity. Investors are willing to do that. Like a bank, traditional bank may not want to sit with equity in a company, right? They are in the business of lending. They will stick to just that, and that is how their model is, right? But a private credit may want continued growth, and they may want to benefit from that continued growth. For example, let's say a company has raised a hybrid loan, right? Hybrid, let's say debt plus equity. While discussions that may have come out that the company wants to do an IPO in 3 years, let's take a simple example. By putting some money in the equity, if the investor sees an upside that, look, after IPO, if I have shares of this company, maybe I'll get a better return. I may bought the share for, let's say, $50. During IPO, the value may have gone up to 200 because they've gotten financing to kind of beef up their business or bump up their business, right? They may get a better upside, right? When they can sell it for $200 4 years later, they will hold on to that, as compared to just getting returns from the debt component of the deal, where they, let's say, get a IRR of X percentage. The key driver of growth that I could think of was rise of AIFs. AIFs, like I discussed, is alternative investment funds. These are all regulated by SEBI. AIFs are basically a pooling mechanism, right? Where a particular AIF is said, there are pools of capital that are coming from different classes of investors who put in the money in the AIFs, get units of the AIF. The AIF then invests money into the companies that they want to do. And these AIFs are typically, Indian guys who have better sectoral expertise, better expertise to India. Simple example, a Goldman may not know India much as, let's say, a Kotak may know, or an Edelweiss or a Piramal may know, right? So they will put in money in the AIF that is run by or sponsored by Kotak or a Edelweiss or a Piramal, for that matter. They will make the AIF will make the investment decision. right? And the monies that are received by the AIF are then given back to the unit holders, who are basically the guys who put in the money. So the investors will just have to put in money. It is the actual sponsor or the investment manager who makes the decisions for the investment, which is in the best interests of the holders of the units. So that has significantly risen in the last few years, especially. So that has been one of the biggest drivers. We discussed how IBC has grown in the last few years or since it's come up. Creditors have found this to be a mode where they can try to enforce their rights as compared to a traditional civil court or civil court process under specific relief or money suit, right? So that has been a fairly long drawn process. You may have heard about it, seen that and all. A typical civil suit litigation may take longer. IBCs try to streamline a process by putting in identified timelines associated with it, that you need to complete the CRP within the next number of days. Obviously, given the size of India and the everything associated with it, it may not happen within that timeline, but it's still a faster means for creditors to enforce and get their monies back. So the rise, you can see through this chart, this is from ENY report on update on private credit in India. You can see that at least as of H1 FY25, there have been at least 8,000 companies which have been admitted into insolvency in different forms. Some 6,000 odd cases have been closed, 1,963 are ongoing. So there's been a constant growth in terms of the number of cases that have been initiated under IBC, or actions that have been initiated, in the hope of obviously getting a resolution for both the company as well as the lender. And again, so one of the biggest drivers, we just discussed this briefly, that how a civil litigation, a civil suit may take much longer. IBCs try to fasten up the process. It's 4 years old, 5 years old now. It's a World Bank 2020 report on ease of doing business. If you see, if you look at the India charts, the number was stagnated around an average of 4.5 years, right, for enforcement of rights. That has significantly in 2020 come down to close to 1.5 to 2. That has happened because people implemented and adapted to IBC, which came about in 2016, had a streamlined process. People were hesitant. People then that business picked up, that mode picked up, and therefore the speed has become faster, which makes it better. You can see it's on trying to come on par with other developed economies, like let's say a US or a UK or Singapore or Hong Kong, for example. So this, I'm sure there's been more fall in the speed of enforcement. So that will basically help more investor confidence, more reasons for people to put money in India, especially through the debt route. So that is another thing that has improved the prospects of private credit. Next point, which we will look at, is the type or strategies that private credit may be in the form of, right? You just say private credit will be basically, you just think of it as a simple loan given by a bank, given by a non-bank, right? That's not just the case. We discuss some of this, the ways it can be. The first aspect is senior lending. When you say senior lending, I'm not trying to bore you with jargon or legal terms in the sense, but basically senior lending is a first rank. You people have security or collateral over certain assets of the company of that they're lending to, or some group companies that they may be belong to. They get a certain identified security for them. So therefore, in case of a default, they can enforce the security. They are the senior most lender in the company, in which case there is nobody above them. They have the first right over that secured asset, or first priority over the secured assets. The returns are also generated typically through an interest payment route, and etc. Next is structured equity or subordinate capital. It is basically something which is junior to a senior lending, but it is still debt, and may also be in an equity-like structure, like an OCD, like we discussed, which is optionally convertible debentures. Optionally convertible debentures, the redemption happens typically by converting that debenture or the amount that is part of the debenture into shares of the company. So it's optionally convertible at the option typically of the investor. But if they feel that they don't want the cash, they would rather keep shares in the company because the company is doing well, that is an option that's given in optionally convertible as compared to a non-convertible debentures, because that is a typical cash redemption debenture, right? And a loan obviously is typically a cash redemption of that cash repayment by the company to the lender. The third thing is mezzanine financing, which is kind of again similar to structured equity or subordinate capital. Is basically a mix of debt and equity. It's not similar in that sense, but in the sense it caters to the need of getting both debt capital as well as equity capital. It may be subordinated typically to bank financing if there is bank financing in the company, The returns here compared to what a structured equity or subordinate capital may have, this may not just have interest but may have other options for the lender to kind of access the equity of the company. It may convert into equity or have warrants which may convert into equity, for example. Next point is something which is again very interesting because of the market that we are in and because of the emergence of IBC. Next to our distress credit, where basically banks or basically the private credit players will purchase the debt from the existing holders through different sources. There are different avenues, like an AIF can purchase, an FPI can purchase, an ARC, which is an asset reconstruction company, can purchase. They will buy it in the secondary market. When we say secondary market, it means from an existing holder of that loan or the debt security. They will purchase it. Let's say the 100 rupees is the outstanding. They may purchase it at, let's say, a 30 or a 40 bucks, right? What happens for the, let's say, the original holder, he gets 40 back. He doesn't have to wait for the 100 to be enforced or 40 to be enforced through a regulatory process, or where he feels that the bank the company is not doing too well. He gets an exit, and the private credit player may come in and then try to maximize its returns by, let's say, streamlining the business operations as well and for helping the management better there. Special situations, again, similar to distress credit in a way. It is basically purchase of or investment into non-performing loans. Moving on to the next point. Again, these are strategies which can be implemented, or the deals that we have seen in the past. One is buying out a stressed business under IBC. So under the IBC process, for people who do not know how briefly that works, company A has gone into IBC under what we call a CIRP process, which is corporate insolvency resolution process. The company, there is a resolution professional that is appointed by the NCLT to oversee the operations of the company during an interim period till the resolution professional identifies a buyer for that company, right? So you run a process to basically find a buyer for the asset. Let's say company A is gone, company B may want to purchase company A. There is a process that is run, typically public process, to find a buyer. Let's say company B is the buyer or the H1 bidder, as we call it, which is the highest bidder. Company B also needs funds to be able to purchase company A through CRP. So company B may take the benefit of financing. You need to show proof of funds, right, to the resolution professional saying, I have the funds to purchase company A. So for that, there may be backers through private credit who will be able to fund an acquisition finance of this sort. That is one of the use cases of this. Second is priority debt, which is basically in priority infra sectors. It may be short term, it may be long term, but typically, let's say last mile financing, as we call it, a real estate project may, let's say, need funds at the end of its almost close to its occupancy certificate. Let's say it may not have access to capital. This is where they may come in. Private credit may offer a higher interest return. It will help the company finish the project. Therefore, they can also monetize that and get the returns out of it. So it's typically short term. It's basically to get the asset on track, get it operational, whether it is an infra project, whether it is typically a short term financing. The third thing is secondary transaction, which we briefly discussed, which is basically a secondary purchase or secondary sale of certain loans or debt exposures to entities like an ARC who may be in the business of this, which is asset reconstruction. That is another way for banks to recover the money. We will touch upon this in subsequent slides. The next point is performing credit. Again, this is companies who may typically not have access traditionally to, let's say, bank finance. It may be for certain identified purposes like growth raise or growth capital. It is again something which is performing credit, meaning that there is value in the collateral or the business in itself. It's not a completely new business that's trying to establish itself. It may have some tangible security to offer to the holders. That is fourth. The fifth is one-time settlements, which, let's say, company has availed loans from the banks. It's not been able to service that out, or the cash flows are not commensurate to service it out. Banks may offer, or the banks may agree to one-time settlements with the promoters itself, where you pay X amount and the loan is extinguished, right? So to finance those one-time settlements as well, private credit may be a route, because the company can then kind of realign its growth objectives and its cash flows to make it better and efficient, so that it can then eventually in the long term repay the debt that was used to pay the OTS amounts. And then we discussed special situations or opportunities that are available. Let's say an acquisition financing, a bridge funding. we have not discussed bridge funding before, but it is basically a temporary or stopgap funding, which which is typically taken prior to an event that you foresee happening in the near future. Let's take a simple IPO. Let's take a simple big investment that will be happening into that company. So that it is typically the proceeds of that liquidity event, let's say an IPO, that is going to be used to repay the bridge loan. It's typically a short-term financing. Yeah, so just to learn about the market size, we discussed the global perspective, but how EY has nicely analyzed this in its report. In 2024, around 9.2 billion US dollars was invested in the form of private equity players across 160 deals. The AUM growth, which is assets under management, has been significant in the last 15 or so years, which has gone from less than a billion to around 18 billion right now. There is increasing role of in local funds and investors, both Indian as well as overseas. There are different types of investors, let's say global players. We discuss some of the used global players. There may be sovereign funds that are invested who may not have the local expertise to kind of do transactions on their own in India. They will put in the money in the AIFs. AIFs generates money for them and gives it to them. Then in terms of deal sizes, we discuss how private credit may not have the ability to kind of finance huge financings, right? Like what a project may require or something of that sort. But that has also been growing gradually because of the type of money or capital that they have or the kind of funds that they have raised from their investors, back-to-back investors. So 50% of the deals in 2024 were about USD 100 million. So yeah, I will take a brief pause over here to see if there are any questions that I can take up related to this, and then we can possibly move on. Let me just. Sorry, Prachi, you're able to see my slides, right?
Yes, sir, your slides are visible. I think it could be a system issue on the participant's ends.
Okay, sure. And you're able to hear me clearly, right? Sorry, I couldn't see the messages while I was presenting because it was not showing up. But
No,
you,
sir, your voice is very clear. Your video is also very clear. I think
hmm,
it could be a system issue on the participant's end.
hmm, hmm. Okay, done. So, Ankur, I think you had a question. I think why are banks not allowed to finance such acquisitions? It may not necessarily be to prevent misuse of funds, Ankur. It's basically you would want an organic source of fund that is coming in and not use leveraged funds to purchase the company. There are restrictions through RBI who doesn't want bank monies to be used for this. It's typically they would expect that they may want own capital to be used or equity sources to be used. Therefore, banks specifically are not allowed, but you can always use NBFCs. And that is how it has conventionally happened in the last few years. And now there are just larger revenues. Yeah, I think that was the only question. The next section is on opportunities. We discussed some of these outcomes when we were discussing what private credit is. But this is basically filling in a credit gap of players who are not able to access the traditional banking system for whatever reasons. We discussed some of those reasons, let's say credit rating, lack of tangible collateral, or lack of tangible security. So therefore, it is some sector where a private credit player may take the punt, basis the future growth potential of a business or the future business plans of that business, where they're confident that even though it may not fall within the ambit of a traditional financing, it's something where they can make the return out of, right? Flexible financing, we discussed this. You will have customized loan structures, longer tenures, shorter tenures, depending on how the business needs that capital to be used. It is not going by a rigid model of using just a particular specific way. So that is where this is a better option or other option that is available to players in the market who want to access it. And from the perspective of the banks or from the perspective of the private credit players, this is typically a high yield instrument. Traditional sense, private equity is 14 to 24% IRR, which is basically an Excel computation of the time value of the money in a very simple manner. It's not a typical interest rate model, but it's linked to, it can be different models like a pure interest component. It can be something called a redemption premium, which you pay at the time you redeem the instrument. So you may not have to pay interest at ongoing intervals, or let's say you may have to only pay a certain percentage as ongoing interest repayments. the balance is required to be paid by you when you redeem the instrument or repay the loan. And the repayment redemption can be from multiple sources, right? The deal may be structured such that you have a certain liquidity event that is happening in the next few years, जिसका proceeds आप use करोगे to repay the loan or redeem the debt. There may be certain, generally you may see an uptick in the business, let's say, happening in a certain duration basis, which the company is foreseeing ability to be able to repay that debt in that manner. So that is how typically is, depending on the nature of the transaction, nature of the use of the proceeds, that it ranges from 14 to 24. Now there are different sectors into which this money flow is happening. One of the biggest ones is real estate. So obviously, some of the players may not have access to traditional capital. So that is one of the, or may need last mile financing to kind of finish the project and recover monies or kind of make the return on the project that they were developing. The second that I would see in terms of the percentage of split of how private credit has been allocated is infra. So infra, there has been a massive push into infrastructure in the last few years. Specifically in the last budget, there was 11.1 lakh crore budget allocation, which there is enough growth opportunities over there for different sets of infrastructure sectors. So there is need for financing over there. There is a need for a diversified set of players. There is a need for competition in that, in the financing space as well. So that is what another opportunity. The third is tech startups, or let's say even fintechs for that matter. These are all companies which may target an IPO in the next few years, given the scale and at which they operate. It is again something that they may borrow to kind of beef up their operations or bump up their operations, such that it makes them IPO ready. And when I say IPO ready, it means in having investors having appetite to fund an IPO or put in money in that IPO. They will not want to put into a company which is not doing well. So they'll kind of use that to streamline their operations, improve their business, improve their margins, etc. So it may be used for that as well, growth stage funding or pre-IPO. The fourth we again spoke about is basically distressed assets, which is linked to IBC-driven recoveries, whether it is investing for helping a bidder buy an asset under IBC or for trying to take the company out of IBC. There are processes associated with that. Like you can, if the company finds a willing investor to kind of manage the business, it can be taken out of the IBC through a process, and special situations like we discussed. So this is again from an EY report, which summarizes that way private credit has seen growth in the last few years. The largest sector which received the benefit of private credit deals is real estate, followed by infrastructure. And then there is healthcare, because if you've seen in the recent past, there have been numerous PE VC deals in the healthcare sector, where we're kind of, I think India is going down the Americanization path of healthcare, where there are huge private credit players backing a lot of the local players in the hospital sector, diagnostics or pathology sectors. So that is another field where we have seen a lot of activity. Then general manufacturing or industrial products, let's say chemical sector for that matter, there have been significant growth. And then comes in your tech and your infrastructure, additional bifurcation of infras into roads, energy, airports, etc., etc. So this is the broad size of where the money is going or which sectors need this more. See, why is real estate on top? Real estate basically, again, like I said, you may have a lot of delays because of which your project may not be complete. You may see a lot of cost overruns which can happen in any infra project where the money, it has taken time to finish, therefore the cost of raw materials has gone up, or let's say the cost of land acquisition has gone up, because of which you need a last mile financing to kind of complete the project and at least recover what you're trying to recover, right, from the project. So that is why real estate will potentially be on top of the list. In terms of deal sizes, you can see typical right now in India, the deal sizes are much smaller. You can see there is typically in between a 10 to 40 million bucket of USD 40 million bucket. Around 50-60% of the total money goes in that bucket. But there are also, if you see more than 120, it's around 11% of the deal size that are around that. There is around 20% in the 80 to 120 million bucket. So that is also the ability of these funds growing to fund larger size financing, large ticket financings. Yeah. The next point is diversification. So you may not need to access the public markets itself as a borrower. That is one. So which may give an investor also may be appealed by that. There is also, like I said, ultra HNIs or HNIs, which are having monies to invest in different strategies instead of just putting all eggs in one basket, where you invest in a typical traditional source, which may be, let's say, equity or fixed deposits or something of that sort. Right? This is another mode that has opened up for HNIs to kind of, or family offices to put in money into an AIF, which can then be utilized and get them better returns than what they may earn, or they may have a diversified strategy for earning the money. There is also Gift City, like which you spoke about briefly, which is they may be able to optimize their tax structuring in a way that will get them better returns through a Gift City model. We'll not discuss that in detail, but this is broadly one of it. And global interest, again, we spoke about this, where there is a lot of investment that's coming in into these AIFs from sovereign wealth funds. What is a sovereign wealth fund? It is basically government controlled monies. Let's say government of Singapore has this fund called GIC, which is the sovereign wealth fund of Singapore. There is also Norway, which has a huge sovereign wealth fund. There are the Middle Eastern countries which have sovereign wealth funds of their own, like QIA and all of those. So they are also investing into the Indian markets. There are also huge global pension funds. I think two, three of the three largest pension funds are from Canada that at least I have seen actively in the Indian market. There is CPPIB, there is CDPQ and OTTP, which are basically pension funds which have surplus to invest, or kind of monies to kind of invest for temporary gains, or for which they may not get in their local market. So that is another avenue that can be explored. Because India is growing at such a fast pace, the returns are also higher. The returns may typically traditionally be higher. So therefore, this may be a better bet for them than investing in their host jurisdiction or local jurisdiction. I will just take questions if there are any in this section. So there was a question from Tanu Ruha. So proprietary firm, I would assume you mean LLPs and partnership firms. If you mean that, then yes, they can also access private credit. It's not that it's just restricted to companies alone. It may be different forms, different nature of entities which can get access to it. There's no real restriction on, let's say, an LLP borrowing capital from these investors. Can you please clarify the ticket size or deal size which you showed in? So the deal size and the ticket size chart that had shown up to you to answer yours was general on a overall private credit in India sector. It was not sector specific. It was overall to the markets in terms of, this was a report done by EY in terms of where they see the deal sizes happening. It may be traditionally the higher ticket sizes are for infra, because I am not commenting on that, but typically infra sectors have high capital needs which can be financed, or let's say an acquisition financing. So that is how. Yeah. So this is just to kind of look at some of the modes. We discussed a broad idea of this, but we'll try to just delve deeper into this as to how it works. There are some of these are some of the routes that I've identified. There are other routes as well, but we'll touch upon these four. One is ECB, which is basically external commercial borrowings. This is typically dollar or foreign currency borrowings. There is also an Indian set as well, but it's basically governed under the RBI master directions, ECB master directions as we call it. It has certain regulatory limitations, regulatory requirements as to how this money can be used. One, what tenor of this loan can be under ECB. There are requirements. There's something called a minimum average maturity period, or MAMP as we call it, as to how long or short this loans of a certain type can be. There are interest rate limitations as to how it can be only X basis points over and above the benchmark rates. So, and you require an approval from an authorized dealer bank for taking these loans or giving these loans. Then the second route is FPI, which is foreign portfolio investors. These are basically, as the name suggests, it's from foreign investors. Again, governed by RBI, because we're talking foreign exchange, governed by the FEMA Act, and also foreign debt management, debt instrument regulations. There are also SEBI regulations which govern how an FPI can get registration, what all an FPI can do, cannot do. There is an overlap between RBI and SEBI, because in terms of how the funds can be used or how foreign exchange can be used is more of an RBI domain. How they can be set up, what are the conditions for setting that up, is more of a SEBI domain. So that is where both these regulators come in. The third is AIF. AIF is basically an Indian vehicle. It's not a foreign overseas vehicle. It is an Indian vehicle. It's a fund which pools in monies from various sources, whether it is foreign investors or local investors, and invest those funds like we spoke. So it is governed by SEBI. There is no real foreign exchange angle involved other than where the monies come into the AIF. But once the monies are in the AIF, it is Indian money. It is so-called an Indian entity investing into Indian companies. The fourth is ARC. ARC is more in the context of stressed assets, stressed loans, again governed by RBI and the SARFAESI Act, which has been in place. So just take a minute to go through the structure chart. This is again not mine, but something that a PwC report nicely summarized the means that are available. So a fund, let's say fund A, can either do in the ECB route, can do in the FPI route, or there is FDI, which is foreign direct investment. There is the sources of offshore financing which can happen. When it's offshore, it's happening overseas, not in India. Therefore, there is masala bonds and there is foreign currency bonds where there's borrowing in foreign currency or Indian currency, but taken overseas. Or there is also an FPI route, which is where you can invest into listed corporate securities as well as unlisted securities, right? There is under the ECB route, you can also provide loans to Indian corporates subject to complying with the conditions in the ECB master directions. An overseas fund can also put in money into an AIF, which comes under the FDI route. If you see this portion of the slide here, which AIF then puts in money into debt securities. The fund can also directly invest through FPI as well, directly into a REIT, which is a real estate investment trust, or an InvIT, which is an infrastructure investment trust, which then in turn the money is used by those REITs and InvITs to finance real estate or infrastructure projects. There are different routes under which they can invest. Like FPI itself has two different bifurcations. There is a general route and there is a VRR route, which we will discuss in the next slide. So this is a brief overview in terms of what a fund can do or what are the typically the vehicles that are seen or structures that are seen for an overseas fund to kind of put in money into India. Yeah, so now coming into the FPI route, like I said, there are two routes. This is a bit legal, so I'll try to kind of speeden this portion up. FPIs are allowed by the RBI and also SEBI to basically invest into debt securities, whether they are listed debt securities or unlisted debt securities. Okay. Under the VRR as well as non-VRR, if you are registered as an FPI with SEBI, you can do these kind of activities. They are permitted under the general route or so-called non-VRR route. They are permitted to invest in corporate bonds with a minimum residual maturity of above 1 year, which is debt having tenure of more than 1 year, remaining tenure. What was the problem, or one of the problems with the general route or non-VRR route was that if let's say a company is raising 100 CR, an FPI along with its related FPS cannot put in more than 50 CR. When I say an FPI, I'm talking about a single class of FPI. Let's say a Goldman FPI couldn't have paid $100 to take the entire debt. They could have put only 50. They would have to find another investor for the balance 50, right? So they were not, their investments into that particular bond instrument or that issuance should be only cannot exceed 50%. Then there are certain concentration norms into how much FPS can invest in particular corporate bonds or the classes of securities as well. And so that is one. Then traditionally, which is for both of these things, if it's a listed non-convertible debenture, there is no end-use restriction. When I say end-use restriction, it is about how the monies can be used, which, like I referred to in the bank sense, you cannot finance acquisition, right? So there were no restrictions at all for enlisted NCD monies to be used. It could be used for whatever purpose that is agreed between the investors and the borrower. In terms of unlisted NCDs, that is cannot be used for, there are certain limited end uses which have been stipulated, which is for real estate, capital markets, or land acquisition. Now, what differentiation did the VRR route bring? VRR is basically a limit that is stipulated by the RBI or the government, which says this is the VRR limit that is available. You as an FPI can purchase that limit through auction or on tap. A tap meaning by just asking the RBI for a limit, you can get a limit. That particular limit that is allotted to that FPI has to be put into certain investments that they're permitted to do within a certain period. Okay. They should at least put 75% of their allocated limits in 3 months. So that is where they will ask for the limit. If they get the limit, they invest it in that. As compared to the regular FPI route, where there's a minimum holding period, there were limits on how much an FPI can invest in an issuance. That is not there in the VRR route. right? There is no holding period requirement. There is no concentration limits. There is no per FPI limit. The only limitation that is there is that your money should be in India for 3 years. When I say India, it doesn't mean it has to be in the same instrument. Today, you have put in money in company A. Let's say the debt is for 10 months. 10 months में पैसा वापस आया, आप उसको कोई और इन्वेस्टमेंट में डाल सकते हो. 3 साल तक वो पैसा इंडिया में रहना चाहिए. That is the only requirement. After that, you can take the money out. You are allowed to take out certain portions of the money out, but you can't take all the money out. Right? So this is what I was discussing in terms of the concentration of single group investor limits and concentration norms, etc. Listed NCDs, if you're doing, which is listed on convertible debentures, that you need to follow the SEBI process. There is a process that is stipulated in the non-debt regulations, or what is issue and listing of non-convertible securities regulations. There are also certain exemptions provided to FPIs to participate in stressed asset financing. They are permitted to subscribe to security receipts that are issued by ARCs. They are permitted to subscribe to debt instruments issued pursuant to a resolution plan under the IBC. And they can also acquire NCDs of companies in default. So these are some of the relaxations which have been given for FPS so that this sector also has enough funding to meet the requirements that are there. Coming to AIFs now, there are 3 types of AIFs. These are governed by the SEBI AIF regulations, like I mentioned. The first stage is what you typically see, which is category 1. Sorry, just give me 1 second. Yeah. The first type of AIF that is there is called a category 1 AIF. It is just the class of registration of that AIF. Okay. It is basically an AIF that puts in money into, like, let's say, startup or early stage or other infrastructure sectors. There are different subheads to what a category 1 AIF can be. Let's say venture capital funds, SME funds, social impact, like as the name suggests, is for social impact purposes. SMEs is to small medium enterprises, special situations, infra funds, all of those. Then there is which is the most common type of AIF that we have seen, which is category 1 AIF. Then category 3 AIF is basically something which is more for derivatives, which will not go into category 2 and 3. What we see in a typical private credit player will typically be a category 1 AIF. AIFs are permitted to raise money from India as well as overseas. There are certain minimum threshold requirements. There are certain minimum corpus requirements, which is 1 CR. So you cannot go and put in money unless you have 1 CR to offer into an AIF. There are also other subcategories. There's an angel fund, which typically puts in money in early stage startups before they even start their growth, or special situation funds, which we discussed. Under the ARC route, so ARC is a interesting model, basically where a company or the instrument or the loan is not doing well. What will happen is that the bank will sell the loan to an ARC. The ARC will issue something called a security receipt to the banks itself, or to from whom they purchased it from. And the banks or the original lender will recover monies pursuant to redemption of those security receipts, which happens basically once the loan becomes kind of depend on the payments that come through. I won't bore you on this in terms of this, but an AF is ARC issues something called a security receipts, which is like a pass-through instrument, which once the ARC receives funds from their underlying loan, that money is passed through to the banks. And upfront, the banks or the original lenders get a certain percentage of the monies as an upfront recovery for them. So over and above that, whatever return the ARC is able to generate, that will get passed on to the banks. So we spoke about special situation funds. So this is an emerging category that is coming through. And special situation fund is basically a fund that invests in special situation assets. Now, what is special situation assets? It is basically stressed loans. Stressed loans is basically loans that are either defaulted or at the risk of default. It may be loans that are availed by a company that is currently under IBC, or basically that is the broad outcome of things. And it is monies that these funds specifically put only for these identified purposes, which is to kind of clean up the so-called, to say from the government perspective, it is something that is to use to clean up the NPAs in the market or clean up defaults to make companies more viable. So that is another category where people are trying to enter because they may try to revive the company and get better returns out of it, because a company may have gone into IBC just because it, let's say, had a poor year. It may not necessarily be a poor company itself since the start. It may be doing well, but because of 1 or 2 years of poor performance, it may have defaulted, because of which went into IBC. And that is a special situation fund may invest into those companies or purchase the existing debt in those companies. I will take a brief pause over here. Yeah, okay. There is no question that I can see. So let's spend some time on discussing the challenges. One is obviously I think you'll get better context when we discuss the RBI report and the findings that they had, but let's just take a brief outlook at what is there. One is credit risk, because you are giving it to borrowers, like we discussed, that do not have access to traditional means of financing. And those means maybe because they do not have, let's say, a tangible security to offer, they may not have a proper credit rating, or they may not be rated itself. So therefore, you are taking a punt as a lender and investor into these type of borrowers, which may not be able to sustain it in the future. So there is a larger credit risk that you, at a lender level, you may have to take. The second thing is market volatility, which may impact every class of lenders, not necessarily private credit, but there may be slowdowns in the market or in a particular sector, which may impact the repayment. So that risk continues across both sets, not just in private credit, but there may be, because you are investing for a special reason or a different, maybe a unique purpose, right? It's not a traditional sense. So therefore, you may not, it may impact the repayment. Third is, traditionally, the portfolio sizes of each of the holders, like we discussed, or each of the lenders is typically smaller. Their ability and risk appetite may be lesser. Their ability to put money in one transaction may be lesser. They may have diversified transactions. Though they may also have smaller portfolios in itself. So you may not get a huge fundraise from private credit player. Next point is basically on tightening regulations. So RBI has obviously taken cognizance of this, so has SEBI, in terms of the growth. So they don't want the system to one day collapse because there has been over leverage in the market. So for this, there have been some SEBI and RBI circulars which have brought in some limits or requirements to make certain disclosures. So there are tighter regulations that have been brought in, which may not be very, so you may have to follow those requirements. You'll have to follow those requirements as well. And there is heightened competition in the market. Let's say what an interest rate that a bank can offer will traditionally be much lower than what a private credit will want to offer. Because private credit are also taking monies from external investors. It may not be own funds. Unlike a bank which is taking money from a depositor, or let's say lendings of its own. It may be able to tap capital at its own level at a lower interest rate, whereas this may not be the case with private credit. So a private credit may not be able to match the financial metrics that a bank may offer. So there is a lot of competition between banks, NBFCs, and private credit players. And also you have emerging fintech solutions right now, which may also be a new competitor in the market. So that is one of the regulatory pressures or competition pressures that are there. Yeah, and again, in terms of transparency, you may not have access, or the private credit player may not want to disclose a lot of data that is available to it from its investors or for its investors. So that is the limited data that may be available. Yeah. So it's interesting to read this RBI report, a financial stability report, which discussed briefly on the role of private credit and what RBI's key concerns were in the market. So if you see the quote that is there, RBI first noted that, look, a bank financing is subject to a lot of regulations and supervisory oversight by the RBI. There are multiple circulars which govern how a bank can lend, at what rate they can lend, to whom they can lend, etc., which may not be so codified in case of a private credit. So they are not constrained by financing from banks. And therefore, this growth, along with interconnectedness with the banks and NBFCs or non-bank financial institutions, may create vulnerabilities that can become systemic. So RBI is worried, obviously, about a systemic failure in the market, which can then lead to a downfall in the Indian economy itself. Something like a 2008 may happen, or all of that, because of over leverage in the market. So what they had noted, which is some of the points we had just spoken about, or what we discussed. One is riskier borrowers. So because I'm not repeating this again, but it's riskier borrowers. Second, investors. There are also, when I say about private credit investors, there may also be insurance companies and pension funds, which are basically money from pension holders or policy or insurance policies, right? If that money is lost by the insurance companies because of a poor deal that has gone bust, they may not have the ability in the future to potentially honor the claims of a policy member or pension claims of a pension holder. So therefore, if something systemically goes wrong in the system, that can impact the general public at a whole. It is not just impacting the borrower as well as the lender. It may impact the systemic rule itself. The next thing is, private credit structures are becoming complex. It's not a simple loan that may be there. It may be hybrid. We discussed some of the models, hybrid debt and equity model, eh, different structures and strategies that are employed. So it is becoming complex. Plus, growing retail presence, like we discussed, HNIs may be investing. There may be in a listed security that it may be open to the general public as well. So RBI may also be concerned with how it may impact the retail investors or retail market as a whole in case systemically there is something wrong. The last point is basically interconnectedness with other segments of the financial system, which is similar to how banks and a bank may also have a separate NBFC of its own. Just because a bank cannot do a particular activity, it may kind of refer the client back to its NBFC who may be able to do that activity. So therefore, in that context, you do not want a bank to be kind of using a different vehicle just for doing something it couldn't have originally done. So that is what RBI and SEBI are concerned about, that you do not use, let's say, an NBFC to get the deal done just because your bank couldn't do it. It should not be a means for you to kind of do something which you couldn't have originally done. So that is what RBI's concern was around. Yeah, so I think next point is generally in terms of structural challenges. India is a growing market. People are trying to explore the market to see what it can offer. So, but for something that is as complex as a private credit transaction, you need to have the requisite talent who have the ability to kind of do such structured deals. You have to move away from a fixed type model. We discussed the last point, which is a limited capacity to do a huge size deal like a bank. For example, a huge infrastructure project. Let's take the simple Mumbai-Nagpur Expressway. That financing was for 35,000 crores, right? In itself. A bank can do that, an SBI can do that, let's say other PSUs can do that. But a private credit player will not be able to do that, may not be able to offer competitive terms, and may not be palatable itself to an investor who wants, may not be palatable to an investor who wants short-term, potentially short to medium-term returns as compared to a project financing, which is a long-term outcome or long outcome project. Okay, so what is the role? Just this is a summation of everything that we have spoken about in the last hour or so. What is its role that it has played, private credit has played in corporate financing? One is it complements what products banks have to offer. It may not necessarily compete with the banks. It may also in certain situation, but it also fills in sectors or markets which are unaddressed or inadequately addressed by banks or traditional capital sources where it's not available. Second point is it enables growth. It helps in the infrastructure development, general tech industry itself, because those are capital means available, may help the MSME sector, which at the end of the day helps in the growth of the country and the growth of the GDP of the country. And third point is private credit has been around for some time. It has obviously been picking up in the last few years, but it has shown resilience even though COVID has passed. It's not that it suffered a downturn and that the market did not pick up after that. So despite the NBFC crisis post IL&FS that we spoke or the COVID pandemic, it has continued to adapt, offered sustainable models both for itself as well as for the borrower in question. Now, what is the future? Because whether you're a lawyer, whether you're a CA, investment banker, etc., this is a very broad pool of human resources that are needed for running all of this, right? You need smart guys to run deals for you, whether financially or legally. So that is a growing sector which is expected to touch 20 to 30 billion assets under management by 2030, which is as per EY. There is a lot of innovation that we're seeing as and when regulations are firmed up. Regulator is also assessing various measures. We are seeing more equity-linked deals. It's not just a pure debt financing. I've worked on a couple of deals where we are doing a hybrid of both debt as well as equity for the reasons we just discussed some time ago. So that is very interesting and innovative for you to kind of challenge yourself to understand what role they can play and what role you can play in these sectors. Whether you are in a borrower who has to have the ability to understand how this is different from a traditional bank and what comes along with it, or what are the riders that come along with it, or whether you are in lender or investor itself, where you need to kind of think innovatively beyond the boundaries or out of the box to get the solution that you're trying to achieve, both for yourself as a lender and the borrower. Fourth point is again something which is for the future, which you may see interesting partnerships with fintechs. You may have seen in the credit market also. You may see a lot of credit cards that are being offered by fintechs, right, in collaboration with banks. It may not be a bank itself, but it's a co-branded card with banks. Something similar we may also see where these private credit players are also partnering up with banks or NBFCs, which may also is at the end of the day better for this country, because you will have more pools of capital, larger financing capacities that will help better this up. So net, this is a growing field. Obviously, like we have discussed, it's gone significantly up in the last 10-15 years. There are opportunities, but there is also the regulator looking at every move that any of these players are making. The regulator is obviously concerned with systemic issues. So it is about how the regulations grow in the future, or how they develop in the future, and the legal reforms associated with that. So it will not be like you cannot go scot-free. Obviously, there will be level of regulation and oversight by the regulators that are concerned, but it is something that is well recognized in the Indian market as a solution that can be offered, which is only helping corporate India more. So that is, I think, the last slide, and I'm happy to take any questions that you may have. So I think there was a question from PU. So while I may not have the exact numbers, like I mentioned, the amount of NPAs that were there existing in the system. When I say NPAs, it is a loan that has been in default for over 90 days. So the NPAs in the Indian system around 2013 or so was over 16 to 20%, right? So, and that has gone down to around 4% or so in the banking system. But there are still companies that continue to go defunct or go bust, which lenders may take into IBC, because of which there are 8,000 cases or 8,000 companies that have gone under the IBC route. So therefore, it may be large, it may be small companies, but you may have read about a lot of huge deals that are happening in IBC. You may have, at least in the financial services sector that I can tell you about, there was DHFL, which was like a 10,000 crore plan value. So that is 10,000 crore worth of financing to kind of beef up DHFL. Or we can see Reliance Capital that's going on right now. It's not that there are just smaller players that are going into IBC. There are huge players, which Reliance Capital, for example, has like around 25,000 crores of debt. That's not a small number. ILNFS is not under IBC. It is going under a specific process that is being controlled by the Union of India. But ILNFS had like 1 lakh crore of debt. This is all public knowledge. It's not something that I'm telling you from internal this thing. So it takes a lot of structures. One size may not fit all. So that is how it is. There are different options. Uh, Sorry, Gopal, I didn't quite understand your question on de-dollarization, because I think you were asking a question more in the context of a potential BRICS currency, right? I cannot comment on that without knowing how it is going to do and whether it is going to happen in the first place. At the end of the day, talking about BRICS or generally as developing markets, let's say in India or even a China is a developed market, but the growth that we are seeing, there is obviously enhanced growth for capital, right? Whether it's venture capital or whoever, there is still startups that are coming up which access venture capital markets at a growing rate. So that is all that I can say, because I cannot comment on something which is not in existence today. So sorry about that. No, so in terms of, there is a question on where to go if I need private credit. This is not a retail borrowing option, obviously, right now. This is something which is more for companies, more for institutions that they access capital. This is for large capital requirements, or something which is for a temporary need at a high yield rate. That is all that I can say on this point, because right now it's not traditionally for a retail investor. It's for something which is for an identified purpose, basis an identified return that you may get because of certain circumstances on how the business does, or what growth capital they're able to bring into the business. I think, Prachi, these were all the questions that I could see on the chat box. that I could answer at least specifically.
Right, sir. So I think the questions have mostly been answered. If there are any left, please do um, share it in the chat box. In the meanwhile, I will ask all the participants to please fill out the feedback form. I'll be sharing the link for the same in a minute. I request all of you to please share your feedback for the session, and the expert will take your doubts for the next 5 minutes, and then we will be ending the session. Give me a minute. I'll just share the feedback form. Please write done in the chat box once you're done filling it out. Or maybe you can give me a thumbs up, whatever works for you. And we will then proceed with the concluding remarks or any further questions.
Yeah, so I'll just give it a 2 minutes for people to who are asked questions can just put it up. I'll then take those questions up together. Yes, I think I can see two questions that have come up. One, AF, is it same as MF? It is not. It's a similar model where you're pooling in funds from different classes of investors. You get a similar unit that is issued by both an AIF to its holders versus what you as a mutual fund investor can get. But the nature and regulations associated with that into what a mutual fund can invest into, what an AIF can invest into, who they can take the monies from are different, governed by different SEBI regulations. So as a concept, they're similar because in terms of the pooling of funds is what they're a fund which pool in money from different classes of investors. In terms of Tanuraha's question, so I mean, as a sole proprietor, maybe the best way, while I'm not a financial expert, the best way maybe to get credit from a bank. But private credit is for special situations, not a general business requirement, right? Traditionally, for any business, you will go for working capital requirements, or if you have some capex requirements, then again, loans associated with that. So maybe as a sole proprietor may not be the right this thing, but any corporate entity structure is what they prefer so that they can control the system in terms of how cash leakages happen or how cash flows can be taken out, which cannot be ensured in a sole proprietor model. Yeah. PU, you had a question on ECBs. So ECB is basically external commercial borrowing, which is governed under the ECB master directions, which has a framework in terms of who can access funds, how they can access funds, who can provide those funds. Right? For example, not everybody is an eligible lender in the ECB framework. Not everybody is an eligible borrower. For just let me take 2-3 limbs of this. Like any entity which is eligible to receive foreign direct investment is an entity which is eligible to take an ECB. Okay. Then there are also certain other entities is allowed to take. ECBs may be in different forms. It's not just loans. It can also be in terms of bonds or debentures. It can be in any freely tradable or freely convertible foreign currency. You cannot take, let's say, you can take money in a dollar, but you may not be able to take in something that is not a freely convertible currency. There are requirements. The biggest thing is there is a list of recognized lenders who can give an ECB. One is there is multilateral and regional financial institutions where India is a member country. Without boring into jargon around this, it is basically large multilateral institution, let's say a World Bank or an International Finance Corporation, which is a subset of World Bank, or development finance institutions, which is an eligible lender. Then there is foreign branches of foreign subsidiaries of Indian banks, which are recognized lenders. And there are individuals if they are holders on equity of that company who can put in money through the ECB route. So there is a limitation in terms of who the lender can be. So it's unlike an FP and AF, which is foreign investors subject to them having a registration. ECB also has a limitation in terms of who these lenders can be. Then in terms of the period of which the loan can be, there are certain requirements in terms of how low the MMP has to be, which is basically if it is for a working capital purpose, if you raise an ECB, the MMP is 10 years. So if it is for repayment of rupee loans or for capex, then it is 7 years. For example, that is stipulated in the RBI regulation, which I didn't specifically go into. And there is a cost ceiling associated. You cannot charge interest rate at the rate that you want necessarily. It is a LIBOR plus 550 basis spread for a foreign currency ECB, or it's a benchmark rate plus 450. So there is a certain list of things which an ECB can be used for, cannot be used for, in terms of what is the period, tenor, everything, and then it needs to go through the AD bank route and all of that. So that is a brief outline of the ECB regulation itself. Yeah, I think that's the questions that I could see, Prachi.
With regards to the feedback form link, please give me 5 minutes. We are figuring it out and we'll let you know. We have shared the link for the form with in one of the answers. Please see to it that it is filled. If you have any further questions, we'll wait for 5 more minutes, and then we'll be concluding the session.